Morning, everyone. Welcome to this morning's edition of the MPC Markets Morning Call, 30th of April, 2026. Stock's looking pretty vulnerable here at the moment. The Fed held rates unchanged, which was largely in line with what was expected. Oil's rallied to about 108 in WTI, 120 in Brent, and we had Meta, Amazon, Microsoft, and Google. Google was the only one that had that was rallying after the close, up around about 6 or 7%. But Meta, Amazon, and Microsoft all disappointed, and have seen movements to the downside in the aftermarket. So this is after the bell here. Google absolutely smashed it. They had a beat. It was a standout beat. 109 billion versus 107 billion in revenue. They beat, and it's up 22%. Earnings per share absolutely crushed consensus, nearly double. $5.11 versus $2.62 on the consensus. Cloud revenue was up 63% to 20 billion, well above the 18 billion estimate. And the backlog for cloud now, quarter on quarter, has doubled to 460 billion. So search queries hit all-time highs with their AI and the accelerating usage, but they managed to expand their operating margins. So net income surged 81%, and they raised their dividend as well. So you can kind of see why they were up. Now for the bad news. So Amazon overall, EPS crushed, 278 versus 163. Revenue was a slight beat. AWS grew by 28%, its fastest pace in 15 quarters, and it was significantly above the 26% consensus. But the problem is, and this is the problem for most of them, is CapEx, basically. So their CapEx guidance surged. So this is Amazon in one quarter alone, 44.2 billion, a 77% jump year on year, which smashed their free cash flow. And their full year CapEx framework remains around 200 billion. So the stock dipped a little bit after market. It was around about the 2% mark. Meta was the one that was hit the hardest. It beat on results, but it was, again, punished on CapEx. Revenue, 56 billion, beat the 55 billion estimate. So, that's like in line really for the Americans. EPS smashed it again, $10.44 versus $6.65 expected. That was boosted by an 8 billion one-time tax benefit. Ad impressions were up 19%. And their price per ad was raised as well. CapEx guidance raised around about 25 odd billion. So it's 125 to 145 billion. So they raised by about 25 billion. Higher component pricing, data center costs, and they're well above consensus. Daily active users ticked down for the first time ever. So they blame that on internet disruptions in Iran and WhatsApp restrictions in Russia. They announced $8,000 worth of job cuts, but they're down about 7 or 8% now in aftermarket trade. Microsoft as well. This was pretty meh. It was basically in line. It's lagging peers. CapEx was below estimate, and it was only down a little bit overall. And it's restructured its OpenAI deal. So, look, the big picture on this is basically that everyone raised or maintained their CapEx commitments. The hyperscaler CapEx is now tracking 700 billion this year plus, and they keep upping it all the time. And but the market's rewarding execution. So Google, Alphabet, which is one of the ones, if you had a gun to my head, I think them and Tesla are about the only two stocks I'd be holding right now. And that's it's been justified in the numbers. Really good broad-based foundation business. And they are it's a lot of the stuff they do behind the scenes. There's innovators, there's innovators everywhere behind the scenes. So this was the market as at the close. So we did have a little bit of a lift up in Mike on the bottom left there, Micron, AMD, Intel. That's the chip sector down the bottom left-hand corner there. But as you can sort of see, it was broadly sort of weaker leading into, the fact that the Fed held rates at 3.5 to 3.75. It was the most divided vote in nearly 40 years, actually, 34 years. So three officials dissented against an easing bias, Hamid, Kashkari, and Logan. One voted for a cut, Moran. which that's just Trump's guy. Developments in the Middle East are contributing to high uncertainty was a new language in the statement. Markets are now pricing 0 cuts this year, possible hike in 2027, which is a big turnaround. Powell's last meeting as chair as well. So basically, he's now through, he's, I mean, if I'm going to paraphrase, he said he needs to stay on because the threat to the Fed's independence is very clear based on what's happened to him recently, which has been dismissed. He will stay as a governor because Kevin Walsh has basically been cleared through the Senate committee, expecting confirmation on the 11th of May. But Powell's effectively promised to keep a low profile, but he feels a responsibility to stick around to keep government's fingers out of it, which was what the Fed was specifically designed to do. So, Trump's really, so out of order here. There is a very specific point to having governments not involved in central banks, and any attempt to change it is, in my opinion, impeachable. Like, that's ridiculous. Even our press here in Australia, who try to press the RBA, they're the adult in the room, the central banks, and the whole point is you put them in, and they're not voted out, and they're not beholden to the public, which the public doesn't know. Not everyone's got an economics degree, and knows about monetary policy. They just think about their homeland. You need an adult in the room, and sometimes we get a little bit carried away. It's like a hangover, and you got to deal with the consequences of gorging on cheap debt and just asset bubbles and spiraling stock and house prices. So anyway, rant over. But ASX is still drifting lower, and it's down about another 50 odd points on the futures overnight as well. Look, I mean, our index being pretty heavily cyclical is probably, and not having those hyperscalers in there doesn't really help us. We've got Brent surged 7% to 120, its highest close in 4 years. WTI up 8.2. As Trump told aides to prepare for a prolonged blockade. He sees it more effective than bombing. And then Iran's revised proposals expected in the next few days. But yeah, basically said no more Mr. Nice Guy, and posted a photo of him holding a gun. I mean, really, as the President of the United States, for God's sake, you would. I was hoping that a little bit of class from from King Charles yesterday may have rubbed off, but yeah, it's probably a little bit too much to expect. Look, here we're back. Apart from that Monday morning futures blowout to about a 120 in WTI, which is the West Texas, and this is the one I'd normally track in the mornings here. We are essentially back towards those highs. It was around about that 112 mark. We've been holding all futures. We added at the dip again. We sold 112s last time. The risk reward wasn't in our favor. We bought those back again around that 88 mark in WTI, and I would expect that we will be looking to be trimming that half of that position again now. Today, I would imagine, because again, the reason we trimmed the first time was it was either going to 140 or back to 80. And the risk reward wasn't in our favor. And in those situations, taking profit is a smart thing to do, whatever your opinion is. And that's just good trade management and good risk management. Again, it's going to be the same. And look, and Trump has got no problems at all, essentially making things up to see this thing, to give the public the impression that things are going well. And I would expect that it'll be the same routine in the coming days, I would imagine. So the Mag, those 4 of the Mag7, and then we've got Apple earnings tomorrow, but 5 of the Mag7 doesn't look like are going to save the stock market, and oil prices up here is not good. And then no rate cuts, and then maybe rate hikes in 2027. This equity market is flat out overvalued. So, and not to mention. Not to mention the fact that it's a midterm year, etc. as well. So just a quick one, Strait of Hormuz traffic, basically negligible. 60 days to normal supply if there's a peace deal tomorrow, which the president's holding a gun and saying no more Mr. Nice Guy. You just add 5 days to that straight up. troop movements. There's still quite a lot of troops in the over there at the moment from the US, and we've got the consumer cost obviously just continuing to spiral overall, and it will continue. This is the oil chart here. Essentially, we were our triple O ETF recommendation, which you could have got on Mosaic. We bought somewhere around this area here. What we weren't too sure. We bought it, as you can see on that chart. There's a large red candle with a large tail. About at the start of March, we bought a couple of candles after that. Somewhere in the mid to high 80s. We obviously tipped some out around the 112 mark, and then we bought back in on that big red candle on the it's probably about 10 candles back, and we will look to trim again, I would imagine, today. You can get these recommendations on Mosaic. It's been a very good trade overall. We also gave some fair warning on trimming your portfolios leading into Hormuz. Didn't do a lot of buying but at the moment we're very firmly in the camp that with oil prices at these around these levels and continued disruptions, investor concerns around capex, despite massive EPS beats and things, where we are a very big fan of this market, over a 3-year period, basically based on Trump, but also based on AI. But this capex disappointment and the midterms and the oil price are going to create this, are going to create uncertainty for the next 6 months. And in a midterm year, we are going to get, we do get those dips of more than 10%. Every 4-year cycle since 1940, so that's 86 odd years. Apple tomorrow will have something from ANZ as well in the Aussie market, just to sort of a bit of a broad update or quarterly update there. The Exxon and Chevron will both report earnings before the open. We've got GDP, we've got in the US and PCE. There's still a slew of central banks that are all going to say the same thing: uncertainty, can't do anything, transient, not transient, whatever. It's difficult time to be a central banker, really, in my opinion, at the moment. So and everyone watches them so closely. So at the end of the day, they're not gypsy fortune tellers, they're economists. So you've got to take things with a grain of salt because they'll be dynamic. But ECB, Bank of England, Apple, Eli Lilly, MasterCard and Caterpillar earnings, and people will be watching out for that that revised Iran proposal. So like I said, we'll be taking some risk off the table there. But as I sort of alluded to before, by the dip, it's our S&P 500 index investment, where you get the lowest Monday closing price as your entry price between May and October, which is this statistically very high period of chance of being a dip. And then it's a 3-year investment in total. So 2.5 years from that October point, and you get leveraged upside of around about 6 times. So it's around the 16 to 17,000 cash investment for $100,000 notional exposure, and the loss is capped at 100% of that cash. Obviously, the market's down, you don't get your cash back. The leverage only applies to the upside. It doesn't apply to the downside. There's no margin calls or anything like that. If you're holding any form of FANG ETF, S&P ETF, etc., this is it's the maths makes categorical sense to be in this, and then from a capital efficiency point of view, and possibly to get some extra exposure point of view, you can leverage your exposure there as well to gain more exposure to the S&P, or you can just do in the notional amount of the existing ETFs you have and use that capital for more conservative investments. Look, I'd be taking advantage of the market being up at record highs here, and then you don't have to then time the market to buy the dip moving forward over the next 6 months, which is it's a pretty good deal. Even if I do say so myself, so scan the QR code, go and have a look at the videos. This thing's going to close in 2 weeks. We need to be engaging with you on opening accounts and things sooner than that, obviously. But overall, people have a great day. I'd probably be looking at the portfolios, keeping one eye on oil, etc. If we see a bust up, and we will speak again tomorrow.
Feeling lost with investing? Meet Mosaic. Mosaic is MPC Markets' platform that turns confusing markets into clear, actionable guidance for your portfolio. Discover Mosaic today. Portfolio and trade ideas in one place for clients and subscribers, powered by MPC Markets.